Good morning. Today we will discuss about the cost volume profit analysis. I am Dr. Arindam Banerjee. I am a faculty at Shivnadar University, Chennai and the fellow member of the Institute of Cost Accountants of India. So, what we will discuss in this chapter is that how the cost behaves and the profitability behaves when the volume changes, right. So, with a change in volume, how the cost behavior and matters in influencing the profitability of the firm. Fine. Now, before going into the further details, let us first discuss the basic assumptions underlying this concept. So, what are the basic assumptions? So, this is learning objective 1, understand the assumptions underlying the CVP analysis. So, first is the changes in the level of revenues and costs arise only because of changes in the number of product or service units produced and sold. Number 2, total cost can be divided into a fixed component and a component that is variable with respect to the level of output. Number 3, when graphed, the behavior of total revenues and total costs is linear, that is a straight line in relation to the output units within the relevant range, that is the level of production and the time period also. Fourth, the unit selling price, unit variable cost and fixed costs are known and constant. So, in our decision making process, we will consider, we assume that this is not going to change very soon. Number 5, the analysis either covers a single product or assumes that the sales mix when multiple products are sold will remain constant as the level of total units sold changes. 6, all revenues and costs can be added and compared without taking into account the time value of money. So, in this case, because we are using this concept, the CVP analysis for short term decision making, so the concept of time value of money we will not consider here. So, operating income I can write like this, that is total revenue from operations minus cost of goods sold and operating cost. We are currently not including the income tax at the moment. So, net income is equal to operating income minus income taxes. So, what are the features of CVP? So, we can understand it with an example, but before that let's put it in an equation form. So, we can write it like this. Suppose I can segregate, as I said, I can segregate the cost into fundamentally two parts. One is the fixed cost, other one is the variable cost. So, for understanding the concept of CVP analysis and decision making, the nature of cost behavior, that is how the cost behaves when the level of production changes, right, that is very important. So, there are basically two categories of costs. One is fixed cost, other one is the variable cost. There is a third category which is actually the mix of variable and fixed cost, that is partly fixed, partly variable, which is called the semi-variable cost, right. So, how they behave with the level of change in level of production, that we need to first understand. So, I am writing like this, suppose I am writing like this, total cost is equal to variable cost, I would like total variable cost plus total fixed cost. Fine. Now, total variable cost is what? Total variable cost is variable cost per unit multiplied by number of units. Fine. Now, in this variable cost per unit, it remains constant. So, if say variable cost per unit is rupees 2, then if I produce 10 units, my total variable cost will be 20. If I produce 100 units, then my total variable cost will be 200. If I produce 1000 units, my total variable cost will be 2000, right. So, if I change this number of units produced, my total variable cost will either increase or decrease, right. So, my total variable cost will be directly proportional to the number of units I am producing, but the variable cost per unit will not change, it will remain same, fine. This is number 1. Number 2 is that by increasing and decreasing the number of units produced, because how much units I am going to produce, that is dependent on several other factors. One of the major factors is how much is the market demand. If the market demand is more, I will produce more. If the market demand is less, I will produce less, right. Some seasonal factors, for example, ice cream, it sells more in the summer, right. So, in summer I can increase the production level of ice cream, but in winter I may not need that, fine. So, depending on that, I can control this total variable cost in shorter run. So, I can control this, right, because I can decide on this, I can control this, right. But variable cost per unit may not be controllable, right, I can't change it suddenly, fine. So, this is the behavior of the variable cost. What about the fixed cost? The fixed cost, I can write it like this. So, TFC, I am saying total fixed cost, right. In the shorter run, I cannot change, it remains constant, right. So, what is the example? The example could be, say, the factory rent the company is paying to the owner if the factory is taken on lease. So, whether I produce 1000 units per month or 10,000 units per month or 1 lakh units per month, the rent I have to pay as per the agreement, as per the lease agreement. So, I can't change that. So, this is my fixed cost, right. So, this is not in my control, at least in the shorter run, fine. So, it is constant and it is out of control in shorter run. In the longer run, of course, all fixed cost becomes variable, I can control. Suppose if I have taken a factory on lease for 3 years, so after 3 years I can negotiate the rental with the owner and can bring it down or bring it up depending upon my business, right. So, I can control it, but for 3 years I can't do anything. Whatever is mentioned in the lease rent agreement, I have to pay that, fine. But however, the per unit, that is if I calculate the fixed cost per unit, that gets changed with the level of production, right. So, say I am saying in our example, say factory rent, say rent is say 1 crore per year, right, and in a year if I produce 1 lakh units, so my fixed cost per unit will be 1 crore by 1 lakh, right. So, it comes to how much? It comes to 1 lakh, 10 lakh, 1 crore divided by 1 lakh, so 5, so 100. So, fixed cost per unit is 100, right. If my unit production becomes 10 lakh, then this fixed cost per unit will come down to 10 rupees, right. So, the fixed cost, total fixed cost, the difference between the total variable cost and total fixed cost movement is the total variable cost changes with the level of production, right. It changes with the level of production, but per unit variable cost remains same, but total fixed cost remains same with the change in level of production, but the total fixed cost per unit comes down. Okay, fine. So, depending upon this, because this variable cost is under control and total fixed cost we cannot control. So, this is the way we can understand that how the cost behaves, right. We will show it later on in a graph, that how we can calculate the break even point depending upon the level of variable cost and level of fixed cost in the total cost structure. Now, let us see one example, right. So, assume that the toy shop can purchase toys for rupees 32 from a local factory. The other variable cost amount to rupees 10. The local factory allows toy shop to return all unsold toys and receive the full rupees 32 refund per unit of toys within 1 year. That means, no unsold stock is there. And what is the average selling price? The average selling price is 70. And what is the total fixed cost? The total fixed cost is 84,000. So, I can calculate the contribution first. Now, the question is what? How much revenue will the business receive if 2,500 units are sold, right. So, how much? 2,500 into 70, 70 is the selling price per unit. So, 2,500 into 70, that is 1,75,000. So, how much variable cost? Variable cost is 2,500 into what is the variable cost per unit? 42. So, 2,500 into 42, 1,05,000. So, my profit is here, profit or loss is here, rupees 1,75,000 is the sale revenue minus 1,05,000, that is the cost, variable cost, minus 84,000 the fixed cost. So, the loss is 14,000, right. But what is the contribution margin? As I said earlier, that in shorter run we are more concerned about contribution margin. So, I can write it like this, write the equation like this, I can write like this: sales minus variable cost is contribution minus fixed cost is profit, right. So, this is the, I would say, the mother equation of the CVP analysis, right. So, in this case contribution, right, contribution is very important factor, that is because this fixed cost in the shorter run I cannot control. What I can control is whatever is there, it is there, but what I can control is the contribution, fine. So, what is the contribution margin? I can write like this: the contribution, here the sales is 70 and my variable cost is 42. So, contribution margin is 28 per unit. So, we am talking about per unit, right. So, total contribution for 2,500 units will be 2,500 into 28, fine. So, it will be rupees 70,000. So, 70,000 is my total contribution, fine. So, what is my contribution margin percentage? So, contribution margin percentage is contribution margin divided by sales price into 100. So, I can calculate it rupees 28 divided by rupees 70 is 40%. So, 40% is my contribution margin. If the business sells, now in the previous case the business was selling 2500 units. Now, if the business sells 3000 units, then how much will be the revenue? Revenue will be 70 into 3000 units, right. So, revenue in this case, the revenue sale will be 3000 units into rupees 70. So, is equal to rupees 2,10,000, which is mentioned here, 2,10,000, and contribution margin will be how much? 40% into 2,10,000, that is rupees 84,000. You remember the fixed cost in the previous case, it was 84,000. So, contribution, you can remember here, you see. So, sales minus VC is contribution. So, contribution is 84,000, right. Contribution, this contribution is 84,000. What was my FC? FC was also 84,000. If you go back here, if you go back, you see the fixed cost is 84,000, right. It is given here. So, 84,000 minus 84,000, so it becomes profit is 0. This point where the profit or loss is 0, this is called the break-even point. So, break-even point is the level of sales at which the profit or loss earned by the company, it becomes 0, right. So, this is called the break-even point. So, to remain, to sustain in the business, the company must always try to sell above its break-even sales, right. In the longer run, to survive in the business, it must continue to sell above the break-even levels. Okay. So, now learning objective 3, determine the break-even point and output level needed to achieve a target operating income using the equation, contribution and graph method. So, we can this relationship we can write in the form of an equation, right. So, I can write like this, as I said, I can write like this, I am writing in the form of equation, selling price minus variable cost is equal to contribution minus fixed cost is equal to profit, right. So, in case of BEP, this profit is 0, right. In case of BEP, the profit is 0, right. So, I can write like this, in case of BEP, right, in the case of break-even sales, right, contribution is equal to fixed cost, because contribution minus FC is equal to 0. So, contribution is equal to the fixed cost. So, I can rewrite it like this, that is sales minus variable cost is equal to fixed cost, because originally sales minus variable expense is contribution and contribution is equal to fixed expense in case of break-even sales. So, I can put it together and I can write sales minus variable expense is equal to fixed expense, fine. So, this is another relationship. So, the first I again repeat the the fundamental equation. The fundamental equation is sales price minus variable cost is equal to contribution minus fixed cost is equal to profit, right. In case of break-even sales, the profit is 0. So, when the profit is 0, the contribution is equal to the fixed cost. So, I can write sales minus variable cost is equal to fixed cost. So, this is my equation in case of break-even sales. Now, there are few abbreviations which we will use in the forthcoming slides. So, sell price is SP, VCU is variable cost per unit, CMU is contribution margin per unit, CM percentage is contribution margin percentage, FC is fixed cost, Q the quantity of output units sold, OI is operating income, TOI is target operating income, TNI is target net income. So, in the equation if I write, I can write like this. Now, you see the selling price usually expressed in per unit terms, right. The variable cost is expressed in per unit terms with the variable cost per unit, but the fixed cost comes in totality, right. Like I gave the example, say factory lease, right. Factory lease comes as a lump sum, right. Whatever be the number of products the company produce in the factory, but the lease comes and lump sum. Okay. So, I can write it like this, in equation method I can write like this, that is selling price into quantity sold, that is the total selling revenue, variable minus variable unit cost into quantity sold, that is total variable cost, minus the total fixed cost, you will get the operating income. Fine. So, now, where Q is the number of units sold, or we can say produced also. Sometimes it is taken on the production basis, right. Now, if I write the same problem in equation form, so it is a selling price is 70 rupees per unit into Q, number of units produced, minus the variable cost is 42 per unit. So, 42 into Q, number of units, minus fixed cost 84,000 is equal to, at break even level the profit is 0. Okay. At break even level the profit is 0. So, now 70Q minus 42Q is 28Q is equal to 84,000. So, Q is equal to 84,000 minus divided by rupees 28. So, the break even sales is coming to 3000 units. What does it mean? What does it signify? It signifies that if the company produces and sells 3000 units, then the company will reach at no profit, no loss point in the short term, right. In other ways, I can say the company will start making money, making profit only after its production level and sales level crosses 3000 units. As we have seen earlier, that when the company is producing and selling 2500 units, the company is incurring loss, right. At 3000 it is break even. So, it is in a no profit, no loss situation. Once it will reach beyond 3000, right, it will start making profit. It will get into the profit zone. So, as it moves up, its profitability will increase. So, 3000 is the break even point. At 3000, the company reaches at no profit, no loss zone. If the production and sales moves up from 3000, it will be profit. If it falls below 3000, it will be loss. This is two things must be kept in mind while understanding this, that this is applicable in a given production level and a given time range, because every cost becomes variable beyond a production level and beyond a time range. Okay. So, this is the equation method. So, contribution margin method. So, contribution margin, what is the formula for contribution margin? The contribution per unit divided by sales price per unit into 100, right. In our example, we calculated it as 40%. So, in this example 3000, what is the contribution margin? 84,000 divided by 40,000, that is 2,10,000, right. If I put it in a graph, the graph will look like this. You see the x axis, it is showing the number of units, and the y axis, it is showing the rupees in 1000, right. Now, the fixed cost 84,000, it remains fixed over the level of production. So, you see here this is parallel, right. Fixed cost, it is parallel. Whatever within a given range, right, whatever be the production level 1000, 2000, 3000, the fixed cost is not changing, fixed cost remains at 84,000. But variable cost is increasing. This the total cost, if I add variable cost, it is increasing, you see it is increasing, and the revenue, if your sale is 0, the revenue is 0, right. If your sale is 0, the revenue is 0 here, and you see it is increasing like this, and at this point the revenue and the total cost, the revenue line and the total cost line, it is intersecting, right. So, this is intersecting at 3000 as we calculated earlier, right. So, this is the break even sales, right. So, your break even sales, as we calculated earlier through equation also, here graphically also we can see that this is the break even sales, right, where it is meeting the total cost, right. And you see here, once the production level moves up from here, right, this gap is increasing. That is the gap between the revenue and the total cost, the yellow line, right, which is the revenue line, and the green line, which is the total cost line. This gap is increasing and the company is earning more and more profit. The opposite is also true. Here you see the revenue, the total cost line here, and the total revenue line. The total revenue line is lower than the total cost line. So, it is incurring, you see, at the here it is incurring losses. Okay. If its production and sales become 0, still the company has to incur 84,000, which is the fixed cost. Even if it does not produce anything for shorter run, for example, but it has to pay 84,000 as fixed cost. So, the loss in this case, in case of 0 production, is 84,000. Fine. Okay. So, this is the how the cost behaves, and in graphic we can solve the break even point in equation form also and in graphical method also, right. Now, in break even point, the total profit is 0, right. But what if I want to know that for a target profit, say my target profit is 1000 rupees or 5000 rupees, and I want to know that how much I need to produce to get that profit, right. That is also possible. That is called target operating income. So, I can write the equation like this: fixed cost plus target operating income divided either by contribution margin percentage or contribution per unit, right. So, I can take one example. Assume that the management wants to have an operating income of INR 14,000. How many units of toys must be sold? So, it wants to make a profit. In break even point, it was, we calculated that 3000 units I need to produce for getting into no loss, no profit zone, right, that I calculated. Now, for I want to earn 14,000 units. So, how many units of toys must be sold? So, I can sell like this: 84,000 plus 14,000 divided by 28. So, we have seen in the example 84,000 is the fixed cost, 14,000 is the profit I want to earn, and this is the contribution I am making by selling 1 unit, right. So, I need to sell how many toys? 3,500 toys. What INR sales are needed to achieve this income? So, this number of units, if I multiply by sell price per unit, I will get the revenue, right. This is one way. Second way is I can divide this fixed cost plus target income by contribution margin. In this case, in our example, the contribution margin is 40%. So, if I divide it, so I am getting the amount 2,45,000.